Good afternoon. Good afternoon. My name is Dana Syracuse. I'm a partner with Perkins Coie, where I help lead the Fintech and blockchain practice. And I'm here today for a fireside chat with Acting Comptroller of the Currency, Brian Brooks.
Hi, Dana. Thanks for having me.
Brian, thanks for being here. It's really quite a pleasure and quite an honor. And I want to thank you for taking your time to share your perspective today on banking and fintech. You've been acting comptroller for almost 4 months, and I think arrived at a very challenging time. Over the past 4 months, what have they been like for you, and is it what you expected?
Is it what I expected? Well, I don't think the last several months have been what anybody's expected. And for me, it's been a little over 4 months. And it seems like it might have been 4 years at this point, given all the crazy things going on. But Dana, what I would tell you is I agreed to do this job at a time when we had 3.5% unemployment and high growth, relatively stable social fabric in this country. And man, how much can change in a short amount of time. So what I've seen in this job is it's all a lesson of not letting the important be thrown off track by the urgent. We're all trying to hold the system together right now. And hopefully, in a few weeks or months, we will be through the current pandemic crisis. There's a lot of other stuff going on, which I know we're going to talk about today. This is not the situation I thought I'd confront, but we're going to get through it.
No, it's definitely an interesting time. You really come, I think, to this role with a very unique perspective on fintech and its various applications. You have a very varied background from O'Melveny to One West to Fannie Mae to being general counsel of Coinbase. How does the breadth of your experience affect your perspective about how the OCC should work with and accomplish its goals compared to regulators with a more traditional background? And what types of insights does your perspective bring to the oversight of the federal banking system in its varied parts?
Well, I would say that my background, for good or ill, it has sort of two things that it makes me think. And I don't know if this is better or worse than other people who've got different backgrounds in this job. But the first thing is, because I've seen a lot of different sides of this, I think it makes me more agnostic about whether the traditional means of delivering banking service is superior to the tech-enabled or more innovative side of things. I think historically you had one of two kinds of people who did this job. You had either people who were bankers and they were heavily oriented in favor of banks, or you had lawyers who saw things in terms of process and rules and everything. But for me, what's been great is I did help run a bank. I also worked at a big a global finance company at Fannie Mae, but also worked in crypto and was on the board of a bunch of fintech companies. So I can't say that one is better than the other, but I've definitely sat inside of a lot of places, and I think that does allow me to have a fairly unbiased view of the strengths and weaknesses of all of those things, because I've seen a lot, which is a great thing. I would also say, I guess, that what it tells me is change is inevitable. Doesn't mean it's good, but it does mean it's happening. And one of the things we have to do as regulators is set up a framework that allows that to be done in a safe way, that doesn't violate consumer protections, that doesn't make the system wobbly. And those kinds of things. And so again, I think some people hear me talk and think that I'm this amazing champion of innovation for innovation's sake, when the fact is markets decide what innovation we want, right? Regulators then have to set up a framework that allows people to get what they want in a way that's consistent with law.
Yeah, no, it's an interesting perspective of helping set up appropriate guardrails while still allowing innovation to flourish. So I guess as a follow-on to that, you've been on record as saying that the OCC is thinking about issuing national bank charters to companies focused on payments. Why do you feel that's why is that necessary when there are various real-time payments projects out there? You have the Federal Reserve that's promised a system by 2024, and you've got companies like Stripe and Square and PayPal that seem capable of developing and offering popular payment solutions and services. And I guess a follow-on to that is, how would a national bank charter for payments companies benefit consumers and improve on the system that we have today?
Well, so there's a lot in that question, but
Yeah.
let's sort of start with the idea that the services that Stripe and PayPal and those kinds of companies are offering are services that 10 years ago were only offered by banks. So the service they're providing is clearly a banking service. And I say clearly because we have a regulation that's been around for about 20 years that says that banking consists of three core services: lending, deposit taking, and payments. So when you see companies that are doing an activity that historically was always done by banks, and now it's being done by non-banks, the question that I ask is twofold. One, are users of that service better off having that service outside the banking system or worse off? And I would argue that it's a little bit of both, to be honest. But they're worse off in the sense that when activities are done by banks, we're able to supervise them. And I think that we have a pretty good balance of the way that we supervise banks in terms of, weighing the costs and benefits of public accountability, of compliance testing, of risk management, and all of those kinds of things. With, on the other hand, a sort of a charter that allows you to operate on a national basis without regard to variations in state law. Those are sort of costs and benefits of the bank charter. So the point is, these companies are doing a banking business. It would clearly be a permissible activity if it were done inside of a bank. So the only question is it a good thing or a bad thing that more and more of that is leaching out of the banking system and into the relatively unregulated, non-bank, shadow bank world? I think that question probably answers itself. The idea of this benefiting consumers is, of course, that we are the cop on the beat that ensures that disclosures get made, that consumer protections are observed, that antitrust laws are observed, and all kinds of other things. And those companies that are doing that business, Dana, they have licenses. They're just state licenses with a relatively light touch system. I say light touch because the fact is that state chartered institutions fail at about double the rate of national banks, in part because states don't have the same resources that we have to supervise their entities. And so, again, it's not like I have a view that these companies should all be banks, but right now they can't be banks, right? No one's ever had the idea that they could be, even though their activity is defined as a core banking service. And so that's really what it's about, is the idea that we cannot look the American people in the eye and guarantee the safety, the soundness, the anti-fraud measures, et cetera, of companies that we don't have any visibility into. And having a charter that covers them is a way for us to have that visibility.
No, and I think that kind of touching upon various points there. We had something like the Fintech charter, the so-called Fintech charter, which itself, I think a lot of companies saw as a potential replacement to multi-state money transmission licensing, when in reality it is a type of national bank charter that would come with greater oversight than MTLs. And therefore, maybe I'm curious to hear your view, but perhaps not be appropriate for everybody, depending on what you're doing. And also, just as outside counsel to a lot of these companies, what we found was the way the charter was discussed in the media didn't necessarily tie back to the reality of what one would have to have in place. So, I mean, I guess, what are your thoughts on kind of that dual type of system, and also the how maybe the messaging in what these charters do sometimes gets confused?
Well, look, I mean, I can't speak to the messaging. If there's one thing I found is that half the things I read in the newspaper are either things I'd never said or things that I said with lots and lots of caveats around them. So, I don't have a marketing department the way that a private company would. So there it is. What I think, Dana, is this is actually not that complicated of an issue. The question is, what is the definition of a bank? It's really as simple as that, right? We have a dual banking system in this country. So there's no question that states have authority to regulate activities that are called banking activities. They can totally do that. We've had that system for 150 years. But so can the federal government, right? So there are California state banks and there are national banks. They're both banks, and the OCC's power to charter national banks in no way impinges on California's right to charter state banks. That's totally fine. What I find puzzling is the idea that somehow it's seen as a threat when we say, well, we think the definition of a bank in the 21st century might not necessarily be tied to deposit taking. There are a bunch of reasons for that, which I could go through. But somehow when we say that, people say, oh my God, that's a unique threat to the state regulatory apparatus. No, it isn't. Chartering depositories directly competes with chartering depositories at the state level. And nobody thinks that there's any threat to any of that. And my point just is, financial services get consumed in different ways in every new generation. And once you've determined that no one activity is the defining feature of a bank, but instead a bank is anything that does any of the three core activities, which is certainly what we think the law says, you quickly realize all we're talking about is having a level playing field for a dual banking system. States can charter non-depository financial companies, so can the OCC. States can charter banks, so can the OCC, because the definition of a bank, Dana, is financial intermediation on any of those three metrics. That's really what the law says.
No, I think you're touching upon something that's important, and then we'll talk about it a little while when we talk about kind of cryptocurrency issues. Is the types of services that newer entities are offering, you can very often find an analog to kind of old law or something, or a service that they were already licensed to provide or chartered to, or it exists within the charter. I think providing those analogies coupled with kind of an overlay for any kind of operational risk that's associated with the new service, that's a very that's a solid step towards, I think, kind of expanding what can be licensed and what can't. On July 31st, you signed the first national bank charter to a de novo bank that was born as a fintech company. This was Varo. Then GECO bought a thrift. Those were, I believe, significant milestones in the evolution of banking, but also the evolution of fintech companies. To your mind, what made those events so significant?
Well, they were big deals for a bunch of reasons. I mean, one is, I think that in both cases, it shows that fintech companies have now been around long enough that some of them have started to achieve a level of maturity that would qualify them for national bank supervision. The thing about our regime, Dana, is that we have very, very high expectations of our supervised banks. And that's why having an OCC charter is seen as prestigious, and it's also seen as safe, because we won't let anybody into the system that does not have a very, very high degree or high likelihood of success. And these are companies, both GECO and Varo, who got to a point of maturity where we felt confident that they could come into the system and not present a threat to the system. So in that sense, it's a great day for fintech. It's also, though, I think, an important sign of what we're talking about when we talk about fintech charters, right? The way that phrase was originally thought about 5 or 6 years ago, when my predecessor, Comptroller Coie, first articulated the concept, was a charter for fintechs that didn't take deposits. But these banks show you that, in fact, many fintechs will want deposits. And so in the case of Varo, they're a de novo bank that is fully approved by the Federal Reserve and the FDIC, and they're a deposit-taking bank just like JP Morgan is. And that model fits that particular company, notwithstanding the fact that we might have legally been allowed to charter them without the deposit feature. Or in the case of GECO, which really is fundamentally a payments company, a really interesting sort of business model to innovate payments in the card space, they came into the system by buying a chartered depository. And again, maybe they didn't legally need to, but that approach worked for their business model. So I think the takeaway for people is, when we talk about chartering payments companies or chartering, fintechs generally, that doesn't necessarily mean, or even most of the time mean, that these are some novel charter that doesn't take deposits. Oftentimes, they will want to fit within one of the existing charters, and both of those companies did that. So two big points, both of them, I think, good for the future of the bank charter and good for fintech.
Fascinating. Moving on the day you became acting comptroller, the first policy action that you took was to sign the agency's valid when made rule, and about a month later proposed a companion rule to address the true lender issues. Community groups and state AGs have said that these actions will result in consumer harm by giving payday lenders a toehold in banking and a way around potentially state usury laws. At the same time, the sanctity of contract and bank fintech relationships are important to the industry and the flow of funds. So what's your view on kind of the rent-to-charter criticism and how the OCC's related regulatory actions of the valid when made and true lender support the orderly function of the industry?
Well, let me start with the first criticism that you articulated. I'll come to rent-to-charter in a moment. So let's start with the idea of giving payday lenders a toehold in the banking system. Let's just ask for a moment, what could that possibly mean? So right now, payday lenders are used by something like 40 million Americans. They're not in the banking system. They're used by 40 million Americans. So I'm going to argue that there's no toehold effect here. These are services that, for whatever reason, are widely used and depended on by millions of our countrymen. Now, those elites among us, myself included, who have access to cheap credit and are well served by the banking system, we might find it somehow icky that there are people who are availing themselves of those kinds of services. But we haven't walked a mile in their shoes. There's a reason why people who have sporadic income or people who have low credit scores, who have bankruptcies in their past, nonetheless need access to credit. And I don't think it's my role to say, gee, I'd rather that you not get credit than that you get credit on terms that I personally don't want to have to deal with myself. I think for us to have a ladder that people can climb in this country, it's important that there be bottom rungs on it. And we seem to be, in this country these days talking about cutting off the bottom rungs, which I'm not comfortable with. So then the question is, what is the deal about allowing banks to participate in marketplace lender partnerships in ways that avoid the application of state usury statutes? Like how radical is that? I would argue that anybody who lived through the 70s knows it's not radical at all, right? In the 70s, the Supreme Court decided that it was a legal use of the bank charter for banks to export their home state's interest rate to serve customers in other states. So the thinking was, if a bank is located in a place like South Dakota or Delaware or somewhere that has no usury limit, and there's a customer whose access to credit in, let's say, I don't know, California, can't get access to credit locally because their interest rate is 10% and market rates of interest are higher than that, it's important that those people in our big country be able to access services outside California to meet their credit needs. That was the decision of the Supreme Court in 1978, which, by the way, was unanimous. And by the way, was written by a liberal Democratic appointee named Justice Brennan. So this was not a partisan issue, nor was it even controversial at the time. In 1980, when the Monetary Control Act was enacted, it was enacted precisely to allow state banks to do the same thing, to export their state interest rate to other places. And nobody thought that was a bad thing. They thought that that was facilitating access to credit across state lines in ways that made the country's economy stronger and gave people options they otherwise didn't have. So I frankly find this debate about predatory lending to be sort of specious, given the history of interest rate exportation at the highest levels on a bipartisan basis. So, the real question then, Dana, is where you ended up, which is, well, will this facilitate a rent-a-charter scheme or a rent-a-bank scheme? So let's define some terms first. What does it mean to have a rent-a-bank scheme? It can't be merely that the bank is exporting interest rates to other states. That's just the bank doing its own business. So it must mean that there's some non-bank that's going to partner with a bank to engage in that business, maybe by letting the bank originate the loan and then sell that loan to the third party, let's say. Historically, I would argue the problem with that is that the bank sort of washed its hands of any responsibility. It would technically make the loan, technically argue that the interest rate was legal, but it would have no involvement at all in the underwriting or the disclosures or the marketing or anything else. And that's why rent-a-bank schemes were bad, is because nobody took responsibility for those things. So what our true lender rule does is the opposite of creating a rent-a-bank problem. We solve the rent-a-bank problem in our rule because the rule specifically says that if a bank is the true lender on a loan, then we will hold the bank accountable for all of those things, for the underwriting, for the disclosures, for the fair lending compliance, and everything else. And so what I really think is going on here is there's just the usual political attack of people on one side of the aisle want to help predatory lenders and people on the other side of the aisle are in favor of consumers. That's just not so. Markets can serve consumers, and they can serve consumers in an environment of compliance. We're going to make sure that's the case. So again, the message I really want to land with your audience is, we get that rent-a-bank is not okay. We want to tell you what it is. It's when the bank refuses its responsibility to comply. And under our rule, we fix that by telling them that if they're partnering in these things, that's fine, but then they're responsible for compliance.
I think that, when having any kind of discussion, define terms and kind of coming from a place of the common language, I think it's incredibly important. Moving on to a topic that I'm very interested in, is a passion of mine, cryptocurrencies and blockchain issues. You recently issued two interpretive letters. One was in July, and then one was just very recently, dealing with regulated national banks' abilities to engage in certain types of digital asset activities. So one is around the custody of digital assets, and you would essentially analogize, I think, smartly to old law, where there are lots of different types of things that banks custody, and digital assets can be one of them, and then also stablecoins. Particularly one-for-one backed stablecoins. Can you talk a little bit about that, and kind of what are the next big steps that we're going to see in terms of banks' abilities to federally regulate banks' abilities to engage in these types of services?
Well, first of all, we think crypto is important for a bunch of reasons, Dana, that you and I have talked about over the years. I mean, one is crypto is widely held, much more widely than most people realize. So we can't just ignore it and hope it'll go away. It's another one of those issues where I don't have to like it or not like it to know that 50 million Americans, give or take, are in this asset class, and they need, the safety and security that bank level custody provides for all other asset classes, right? So it's not up to me to discriminate against one versus another, but it is up to me to make sure that bank level risk management is applicable to those kinds of businesses. The stablecoin issue, that's more interesting. Okay, custody I think is really easy. Stablecoin is more interesting in the following sense, and that is many of our global competitors have been exploring the concept of central bank digital currency or some other kind of real-time value transmission system. You mentioned earlier the idea that the Federal Reserve is working on a government-led system that might or might not be delivered in 4 years, right? But these stablecoin blockchains exist today. So whether these stablecoins are transacting on Ethereum or Algorand or some other blockchain, the point is that technology exists now. Literally billions of dollars of circulating supply exist. Hundreds of billions of transactions have occurred already with US dollar denominated stablecoins. And so the issue banks need to confront is, what are these darn things? Are they money in the traditional sense? Are they native tokens of a payment system that allows us to transact instantaneously without having to wait 4 years to see if a government system actually materializes or not? And so what we're trying to say with our stablecoin letter is, hey, banks can support those things. These are legitimate private ventures. They raise certain kinds of risks that need to be managed. Okay, that's one reason why we talk about the idea that for the on-ramp and off-ramp part of the transaction, the bank needs to make sure that they're either receiving money from a hosted wallet or sending the redemption to a hosted wallet for purposes of BSA compliance. But generally speaking, our view is blockchains are important. Blockchains may represent a real-time payment system of the future that exists already. And we don't want to step on that or prohibit that from happening by not being clear about these things. I'll just tell you an interesting story, which is just this morning I talked to the board chair of one of the world's largest banks, a bank based in Europe. And to hear him talk about the concept of stablecoins and CBDC was way more innovative than most people in the United States are in thinking about these issues. I mean, Dana, we are behind in an industry that we're supposed to be leaders in. So we need to catch up on this stuff. And, again, my view is I'm not saying this is better or worse than any other thing, but if the technology exists, I want to put a frame around it so it can be used and understood better and potentially accelerate the course of American economic growth and leadership.
No, I think that's it's fascinating, and the leadership that the OCC and other regulators are taking here in the U.S. I think it's sorely needed. We have 1 minute left, and just as a lead in to our next panel, which is on DeFi, which decentralized finance, which can include decentralized lending systems, decentralized exchange systems. Kind of zooming out, do you see those systems existing side by side with traditionally regulated banks, or at some point will certain aspects of that those services be absorbed into by these, I guess, centralized intermediaries? How do you see that happening?
Yeah, look, it's very hard to know. I mean, we're on the cusp of a real revolution here, and nobody can predict the outcome of a revolution. But I guess I would just say it would surprise people to know that I brought in the founder of one of the biggest DeFi protocols to speak to the OCC executive committee just 3 weeks ago. I mean, like, we're looking at these things very seriously. And I don't think that kind of thing would ever have happened 2 years ago, but now we realize they're here and they're real and we need to understand them. I've said before, Dana, that I think that there are a lot of roles banks will play in the future. One is as a value add on-ramp onto the new decentralized networks of finance. But another is the idea that banks may well be node validators, for for these blockchains. And one of the things that banks do is maintain ledgers, and that's fundamentally what blockchains are. So the idea that in the future banks might connect to these blockchains and perform the validation function and add computing power to the system probably is consistent with the role they've played before. It's just they used to do it on a centralized basis, and in the future they might do it on a decentralized basis. Believe me, banks are important, and as long as we're thinking about the next step of way consumers want services, they'll remain important.
Thank you so much. I see that our time is up. Thank you for being here today. Really appreciate it.
My pleasure. Thanks for having me.